Welcome, everyone. I'm Mike Brashazade.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey everyone, welcome to Q2 of 2024, and welcome to another exciting episode of the What Matters podcast, where we delve deep into the world of wealth management, exploring the insights and experience of industry leaders. I'm your host, Mike Brashazade.
And I'm Ashley Ward.
And today we have a very special guest joining us, Scott Reed, the CEO and co-founder of Hardy Reed LLC, one of the nation's leading fiduciary advisory firms based in Tupelo, Mississippi. I hope I pronounced that right. Scott has become one of the most respected and entertaining voices in the investment world regarding fiduciary excellence and investment ethics.
From speaking at national and regional conferences across the country to helping rewrite the Code of Ethics for the Investment and Wealth Institute, he has become known as a voice of reason in the industry that has struggled with conflict between doing what is right for its clients and what is profitable for its business. Scott Reed is also the author of Top 40 Rules of Investing, an engaging and practical view of successful investing practices. Welcome to the show, Scott.
Yes, welcome.
Thanks for having me. It's fun to be here.
Yeah, we're excited to have you here with us today. Thanks so much for taking the time. Let's delve right in. So, Scott, let's kick off by exploring your journey behind building your RIA. Can you share with us and our listeners your origin story and the experiences that led you and your partner, John Hardy, to establishing Hardy Reed in 2006? Yeah.
2006. Well, we started on we were both in the brokerage business. I started the first full-service brokerage firm in North Mississippi in 1985. There wasn't a physical presence in North Mississippi, and he came along in 1986. In 1987, we shook hands and decided to become partners, and worked without a contract until 2006 and started developing our team. And we were basically stock jocks for a while, and you may remember 1991. We started doing institutional business about 1989. In 1991, the Brinson Biebauer study came out, which they'd done it in 85. They'd redone it again in 91. And it basically said, hey, we looked at thousands of participants in the 111 of the largest pension plans in the country to see how they gotten their results over a long period of time. 5% from security selection, 2% from market timing, 93% from asset allocation. And in 1991, I'd been in the business for a while. I didn't know anybody in the business that had a clue how their clients' money was allocated between asset classes. Everybody was going, "Hey, you should buy some Walmart today and open an account with me." And and that's security selection and market timing, but they had no idea how the Walmart fit into the picture of the asset allocation model. And we said, if that's anywhere close to right, we should be spending almost all of our time understanding how to create asset allocation models and build portfolios for our clients. And so we started developing this team that did that, and we got pretty good at it in the 90s. Around the turn of the century, John and I both got our Certified Investment Management Analyst designations, which is kind of, I think, the gold standard in our business for creating portfolios and doing due diligence on them. And then we kind of drank the Kool-Aid of the Center for Fiduciary Studies and their best practices for fiduciaries. And so we started acting as fiduciaries in this asset allocation model portfolio management business that we kind of created. And when you layer one on top of the other, it's pretty powerful. But brokerage firms don't really want to have anything to do with you actively going on and taking fiduciary liability for every client that you work with. And so we came to a very amiable, really respectful end to our brokerage side and started our own business in 2006. So we could do what we wanted to. And our mission statement when we started was to create a conflict of interest-free environment for clients. We figured you don't have to be that smart. If you work hard and don't have conflicts of interest in our business, it's, as we say in Mississippi, it's not rocket surgery, right? It's not rocket surgery. It's you can be pretty good if you just kind of align your interests with your clients. And so that's how we got started in the business in 2006 as our as an RIA in our own, and managing our own process.
So tell us a little bit about your firm there. You guys have grown your AUM to over $1.5 billion, and
$2.5 billion.
Oh wow!
Well, so let's be clear. AUM and AUA, right? Assets under management, assets under advisement. The definitions for those with the Securities Exchange Commission are both different and also confusing. So, but we're really just under $2.5 billion in assets under management and advisement. We're, I think, we're probably $1.95 billion under management, and the rest of it's under advisement.
Really cool.
Yeah.
So, tell us about that growth there. And again, public information, doesn't generally, share how large that the company is. We go up by the information that we have, and we try to make a guesstimate from there, depending on what month it landed on.
Sure.
But if you could talk to us, how did you grow your company to that size? Do you guys do organic growth, inorganic growth? Talk to us about that.
Yeah. So we have often looked at doing inorganic growth. We've had letters of intent signed. We just cannot get the culture fit right. So all of it's been organic growth. I don't know that we meant for it all to be organic growth, but it sure is easier to control the corporate culture when it's all organic. It's what we did was a little different and maybe required some long-term view, in that when we started Hardy Reid, we gave up our Series 7s. We gave up all our licenses that allowed us to collect commissions. We gave up our insurance license. We gave up 20 years worth of trail commissions in one day. That hurt. We gave up, all of our annuity business we left behind. And so we just wanted to create this conflict of interest-free environment. You can't do that if you're accepting commissions, and you can't prove it if you're licensed to accept commissions. So we just gave all of that up. And when we start looking at other firms and thinking about acquiring firms, you can agree philosophically on a lot of stuff, but when you start telling people they have to give up income that they're earning every year and not doing much of anything for, it gets a little tough. And everybody wants to hang on to part of their business that we don't want them to hang on to. So that part of it's just been really hard for us to find the perfect fit there. So it's just been, we're not against acquiring. We're just can't quite get it done the way that we think we have to benefit our clients.
And how many total advisors are at your firm now?
Oh wow, that's a good question. Let me count. I think we probably got 10. If I had to just throw the number out there right now, we've got about 18 people on staff, but we don't have a huge staff. But RIAs in this country are they're a little bit of an anomaly in our business, in that they, most of them are $150 million to $500 million in assets under management. They're really good at what they do, but RIAs are just kind of by definition, I think tanks, right? They're places where people go to have you think about their situation and create something for them that's special for them, and then guide them through that process. So they don't, our biggest value in the world of investments is to talk people out of shooting themselves in the foot, which they try to do a dozen times in a career. And those dozen times that you can stop them from doing that can produce massively better results. And so, and so I think that's kind of where the importance is. But we don't just fill people up with call centers and things like that. And in our business, I mean, really, I could have opened an account to sell to buy 100 shares of Apple computer, and start an account at a brokerage firm. In the RIA business, we really say something much more difficult, which is, hey, I know you've worked really hard all your life. You've earned some money. You've done a really great job of taking care of yourself. So I know you don't know me very well, but if you could give me everything you've ever earned, I'll just take care of it for you at my discretion, and we'll be great. everybody will do great. And they go, why would I do that? It's a long learning curve to be comfortable giving somebody everything you own. And that is a different animal. And so I don't think for the most part, RIAs in this country are built on seeing how many people you can get in the door to call clients and try to talk them into starting an account. It's really a different animal, at least in my view.
So if you could talk to us about, how you guys form relationships with your clients. Did that all happen by word of mouth? Do you guys have a CMO? Tell us a little bit about that.
Yeah, so Mike, that would be great if I understood how we got our clients. That would just be super. So if I say anything really good, maybe you could record it, send it back to me, and I could learn from myself. It's a lot of it is word of mouth. A lot of it is just getting started. We had a 20-year business in the brokerage side, so we brought when we moved over, we brought about $125 million with us. We left about $85 million to the brokerage firm because we didn't think it was appropriate for us anymore. It was a brokerage account. And so then we just started building from there. And really, my view, and I talk about this a little in the book, but my view is that if you get out there in the world and you participate in your industry, you participate in your community, you give people a chance to see how you act and how you make decisions and what you do. And at some point, they'll probably think, this is probably somebody I wouldn't mind working with. And they give you a call. And so a lot of it's pretty hard groundwork, but it's really just making yourself available to join in to the effort and be one of those folks that people get to be around and work with on another level, and then have that translate to the investment side of the world. That's how I've built it. I can't speak for everybody in the firm. That's certainly my view on how I've built my business.
Thank you.
And so Hardy Reid has been named one of the 50 fastest growing RIA firms in America. I'm curious, was there a certain year that growth was experienced predominantly, or was that just consistently grown through the course of those 18 years?
So, those are always a little bit misleading. We work the same amount of effort. We put the same amount of effort in every year. And some years it works out and some years it doesn't. I'm not really sure what happens when everybody starts calling in and saying, I'd like to be a client, because I worked just as hard the year before when no one called in. And so I don't really know how all of that works. But we did have one big year. And honestly, and this is to get off on a part of the business that is more technical, but how the Securities and Exchange Commission views assets is critically different. Assets under advisement versus management, and how a 321 retirement plan advisor is different than a 338, and how do you calculate your assets under advisement versus management? And they only talk about assets under management when we talk about growth. And so we have 4 divisions. We have our wealth management division, which is our private client division, family and individuals. We have retirement services, and then we have foundations and endowments that we work with. And then we have fiduciary services. And we do, at one point, we did more fiduciary assessment work based on the Center for Fiduciary Studies Foundation than anybody in the country. And none of that's counted. And so I do think one of the years that we got that, we've gotten it a couple of years, I think, but one of the years we got that, we actually were bigger than we had been reporting, and then they changed the calculation for advisement and management. But we have grown. We have grown from 125 million in 2006 to, depending on advisement and management, to about 2.5 billion now. So it's been good growth.
Yeah. Absolutely. Were there any specific challenges that you encountered during that time of founding your firm, and how did you and your partner overcome them, or the team as a whole?
Well, we had one small challenge. We started in August 16th, I think, of 2006. We got going. We left a lot of money at the place we left because we thought it was the right thing to do. We started building our business up. And then in November 2007, there was this thing called the Great Recession that started. And so we barely gotten traction when we got punched in the mouth by the Great Recession. And so that was but by that time we'd also been in the business 21 years, and we'd seen the Black Monday, and we'd seen every other crash that had happened, and the flash crash and all of those, and things had worked out. But the Great Recession lasted from November of 2007 to March 6th of 2009. I know that because March 6th was the lowest close. It went lower the next Monday. That was a Friday, and it was my youngest daughter's birthday. And so at that moment where things had never been worse, I had to go home and have a birthday party and pretend like I was doing great. So I'll remember the day that it bottomed out very well. And so that was a long time, and we had to do a lot of scrambling around. We wanted to keep all of our employees, and we wanted to keep everything intact because we knew the market would turn around. We knew that the market wasn't going to zero, as some people really thought it would go to zero.
Yeah.
Which is amazing because the day the Dow Jones Industrial Average started at 7. So it's actually never been zero, right? And so we just had to keep everything intact until things turned around, and they did. And so probably one of the proudest moments I have in our career was the fact that we did not lose a single client in the Great Recession. We didn't have anybody leave the firm, which I think is just extraordinary. And it took a lot of work, but I think they're happy that they stuck around.
Well, would you say that was your guys' most difficult year or time period in the business?
Well, I mean, it depends on what you think, what you call difficult, but it certainly was the most financially challenging because we were, in an asset under management business. Everybody loves to say you profit when your clients profit, but you also lose money when your clients lose money. And so, and that was happening at a pretty strong pace in 2008. And so we had to, call, if we were in the brokerage side of the business, we could have made some money just by selling everything when you shouldn't be selling everything. But everybody wanted to sell. So you could talk people into selling anything at the time and make some money. In the fee business, where you're actually have an incentive and a responsibility, legal responsibility to act in the client's best interest, you have to talk them out of selling anything. And it doesn't matter because you can't make money selling, you can't make money buying. You just, you're an asset under management fee RA. And so we got to do a lot of good stuff that year, but it was a financial challenge, but we got through it. Things happen.
Yeah.
Markets are down 30% of the time. They're up 70 and they're down 30% of the time. It's an extraordinary number. If you try really hard to not screw that up, you can do really well. If you try if you don't wake up in the morning thinking that you're smarter than everybody else, and just let the market give you what the market's supposed to give you. If I walked into the Golden Moon Casino in South Mississippi and they said, Mr. Reed, if you go to blackjack table 12, you'll win 70% of your hands, I would have moved my family to the Golden Moon Casino, and they'd stay in a suite upstairs, and I would go down every morning and play blackjack because that's extraordinary.
Right.
And so, and our markets have been doing that since, for the last 125 years. And it doesn't matter. People keep saying it matters. That this time is different, which, John Templeton said that the 4 most dangerous words in our business are this time it's different. But we had an agricultural society, and during the agricultural society, stocks did about 10%. Then we changed to an industrial society where stocks did about 10%. And then it was a technology society that drove our country, and stocks managed to do somewhere around 10%. And now we're a service society, and it appears that we're going to do around 10% during this session as well. So, I mean, that's the free market system. That's what we get. And if you try not to screw that up, I think you can do really well in our business.
Yeah. Thank you for sharing that. That's for sure a challenging time to start a business right before that has all happened. So I want to shift gears a little bit, talk about you.
Right.
You've become a very respected voice in the investment world when it comes to fiduciary excellence and investment ethics. You've authored a book, The Top 40 Rules of Investing, and a little birdie told me that you have a second edition coming out this fall. Can you tell us what inspired you to write the top 40 rules, and what can readers expect from the upcoming second edition?
Well, they can expect 10 more rules, so it's actually going to be the top 50. Our second edition is the top 50 rules. So if you got the first book, you can still buy the second one and get 10 more rules. But I've written a financial column since the early 1990s. I had nothing to brag about, but 50-something newspapers at one time, and 3 contracts a month, and I was kicking those things out pretty often, and I got to a point where at one point my brokerage firm had been bought by a bank, and then I was also doing this fee-based stuff and under them, and at one point I had 5 compliance offices that had to approve every column that I wrote, and it was impossible to get anything out the door. I mean, if I had said in the 1990s that everybody would have been well off if they'd bought Walmart 10 years ago, they go, really? Everybody? I would go, yeah, have you seen what it's done in the last time? We're talking backwards, right? Not forwards. It's pretty obvious everybody would have been well off, but should they have bought Walmart? I said, they should have. Now that we know what happened, they might not should have back then. And so it just got really frustrating. And then I realized that the compliance departments can't really say anything about your own opinion. Investment philosophy is philosophy. Mm-hmm. And I minored in philosophy. I like the idea of thought processes and things like that. And so I started writing columns based on investment philosophy, how to think instead of what to do. And so when I went to a publisher about another book idea I had, he said he really wanted me to write this kind of thing I've been doing in my columns, which is investment philosophy in short chapters where people can read a chapter in 8 to 10 minutes. And so I've always loved Casey Kasem's Top 40 when I was growing up, and NCIS has Jethro Gibbs has these rules that in the show, and I always thought that was kind of cool too. So Top 40 Rules is how we did that, and so we just talk about investment philosophy and and how people should think about things, and it really has kind of caught on because there aren't any investment philosophy books out there that aren't 500 pages with 200 pages of footnotes and just kind of practical guide books on how to think instead of what to do. So that's how the book came about, and it did well. It did really much better than I thought it would do. And so I have a new publisher that I'm working on some other projects with, and they wanted to do a second edition of this, and they wanted me to write 10 more rules, so I did that. So it's coming out in August.
Oh, fantastic. Very exciting. And I take it it's written in a sense for someone who doesn't have to know that much about investing, already previous knowledge, can it be for...
I hope so. I hope so. That would be great if it were written that way, wouldn't it? So I hope it is written that way. It's a great beach read because it's a fairly small book and it fits in your beach bag. And Perfect. If you do some of the stuff, you can pay for your vacation.
There we go. Where can people check out your book?
Well, it's coming out. Well, Amazon. You can get it on Amazon or in independent bookstores. But the Top 40 Rules, the Top 50, coming out in August, will be the same. It'll be published by Morgan James Publishing Company, and It should be everywhere, but we'll see when it comes out. But anyways,
looking forward to having those next 10 rules come out.
I mean, and the other thing I'll say about it, if you think about financial and investment training in our school systems, there's, first of all, it's almost non-existent. And the things they do are things like the stock market game, which teaches you the nomenclature and then teaches you how to gamble. And then really every, course in college and high school teaches you how to gamble. The stock market game says, hey, here's some fake money. You got 6 weeks to see how much money you can make off of it, which is not a time horizon in our business. 6 weeks is not a time horizon. If somebody needs money in the next 18 months, it's probably going to be in cash. But we just teach people how to see how much money they can make in 6 weeks. CNBC used to have stock pickers come on Monday and give us their stock picks, and on Friday they would come back to see how they did. So 5-day time horizon on stock picks, and so this is the stuff people are watching, and I think it's just really detrimental to long-term success in investing, the way that we promote our industry as a whole.
I was going to say, is one of those stock pickers Jim Cramer?
Well, I think Jim's really smart.
Yeah,
I'll just say that. I'm not sure his advice applies to most of the people that listen to it. But it's that part of the business is a fun part of the business. I mean, what I do is literally the most boring part of the business you can possibly be in. Nobody wants to really talk at length about non-correlating asset classes and standard deviations and all alphas and Sharpe ratios. They just want to know the next hot stock and the story behind it. They want to get behind it, know that they're saving the world. They want something to talk about at a cocktail party. I've got nothing to talk about at a cocktail party. Somebody asked Warren Buffett, why don't more people do what you do? And he said, because no one's willing to get rich slowly. In our short time attention spans and all of that stuff lends itself to these storytelling, buy and sell mentalities that for the most part, most people don't need. But I'm also kind of I'm a middle of the road guy. I'm a fiduciary who doesn't think that most people need a fiduciary. And most of the people, one reason I've done a lot of talking around the country is because I'm really one of the only people I know who hasn't taken a side. Either you think fiduciaries are terrible or you think everybody should have one. And I think that, in my opinion, if you want to control your own destiny, you want to be the captain of your own ship, you want people to feed you information, you want to make those decisions yourself, and you want to be in charge of your destiny, then I think that we would be terrible for you, because what we're going to do is take our discretion and we're going to manage the day-to-day process of creating portfolios for you and managing those portfolios. And you don't get to be the captain of that ship. You get to be the coach. I mean, you get to be the owner, but not the coach. And so I think a lot of people, maybe more people than need fiduciaries, need a brokerage relationship or something like that. But the people that need a fiduciary need us desperately, and it's almost impossible to tell who we are, because everybody in our business wants to say they do what we do. Mm-hmm. And I saw a stat a couple of years ago that said that 85% of the people in our business get paid by the product, at least in some form or fashion. And those people don't do that, but they say they do.
Thank you.
Yeah. So building on that, what are your thoughts on the future of wealth management? Where do you see the wealth management industry heading in the next 5 years, next decade? Any trends, technologies, or strategies that you really see shaping the future of the industry?
Well, I just think it's, I think that at some point we're going to realize when I started the business in 1985, I started with a brokerage firm that was the second oldest member of the New York Stock Exchange. And the only reason that mattered is because you had to be a member of the New York Stock Exchange to buy and sell securities on the New York Stock Exchange. And member firms got information, public information was disseminated, and then it hit the nightly news at night. But people didn't have, I'm dating myself actually, but people didn't have cell phones back then. They didn't have immediate access. And so there was some advantage that you could get in an inefficient market where information was spread out over time, even if that time was hours or a day. You had information before other people had information that was considered public, and you could take advantage of that. And ever since computerized trading and the internet and then cell phones, where you've been in a meeting where something big happened and everybody's phone starts buzzing, everybody gets information at the same time now. The efficiency of these markets has gotten so enormous that the idea that you can have an advantage is just almost ridiculous. And so you've got to say and now I'm starting to preach. I don't mean to start preaching, but so you don't have an advantage. So the thing you have to do is you have to have a lot of track and error. You have to not look like everybody else if you're gonna really outperform. Well, the problem with that is clients don't have patience for you if you're underperforming for a long period of time, so
Right.
you can outperform down the road. And so you don't actually get to be a good money manager if you don't have any money to manage. And people will just leave you if you have 4 or 5 years of underperformance. And so now money managers are trying to get as close as they can to the index and still say they can beat it, which I think Eugene Fama in 2013 won the Nobel Prize for his research that said, hey, there are managers that can beat the index over time. B, only 2% of them can. And so 98% fail to do that. And C, those 2%, it takes about 37 years to figure out if they're good or lucky. And so what you're looking for now is that 2% that can beat it. And you won't know until it's too late to do anything about it if they actually can. And so you've got to start wondering, is it a fool's errand to go out there and try to beat indices these days? And really the math is against you to try to do that. But that is the most exciting part of our business. And so if you want to go to a cocktail party and tell people how smart you are, I was at a cocktail party once, and a doctor that was there started telling me all this stuff that I should be doing with my clients. And after about a 5-minute diatribe on
right, because he knows everything, right?
Yeah, and after about a 5-minute diatribe on what I should be doing, my wife just very pleasantly looked at me and said, "Scott, do you have any medical advice for him?" And and everybody just broke down laughing. But so that the boring part of the business will get you where you're going, but there's a much smaller range on what you can earn, right? If you let the markets come to you, you really can earn somewhere between 2 and 12, not 25 and 30%. And the way to earn 30% is to buy one stock and hope that it works out, which is a tough, that's a tough long-term plan.
Yeah.
Yeah.
So talk to us about the future of your firm there. Do you guys have the next generation in place, or are you guys looking to continue to grow? Where do you guys see yourselves 3 to 5 years out from now?
Yeah, have you heard anything? That would be great for me to know if you've heard anything of it. No, it's we are actively developing the next generation. We have people here that have been here for a while that I think are poised and ready, and then we're building up that a whole group behind them that will be ready to go. We have done what I think is critically important if you want to be generational, and that's to institutionalize your process. So clients are clients of the firm. They're not a client of an individual. Teams and the whole firm can get involved when they need to get involved. The best person at any given time for any given problem is going to be working on that problem for a client. and everybody understands the process that we use to determine everything from portfolio construction to due diligence to search and selection and to how we go about trying to get clients. And so I think that we could go a long time if John and I took a dive in a Boeing aircraft that hadn't had the nuts and bolts locked down on it yet. I think we would be years before our clients really saw much of a difference. And so I think that's the critical part of that. We're certainly large enough now where everybody, it seems like a lot of people are interested in talking to us, but we just hadn't had that much interest in that to this point.
Thank you.
Yeah, it's a great point to consider there. So shifting gears a bit, investments in sectors. What are you currently most excited about right now?
So, okay, Ashley, you're just going to make me look even more boring. I'd rather you ask me a question that made me look like an exciting person that people wanted to hang out with, but that's all right. That's all right.
We want to hang out with you.
No, that's all right. I can take it.
I mean, you're an author, a musician. You're far from boring.
Yeah, well, but this answer is, you're not going to like the answer. So the market is up 70% of the time, right? Down 30% of the time. The market averages 10, actually in the last 100 years, it's averaged about 11.5% the equity market, but around 10% a year. The only way to get that I know of is to own everything. You have to own all the losers so you can own all the winners. And I don't know that I'm smart enough to take bets on sectors or to take bets on individual companies if my goal is to get that market return. And so our goal is to get the asset allocation right and then have average returns in each sector of that asset allocation so we get to where we want to be. And we know that we're going to get there over time because it's a free market system and we know what it will give us. And so it is, Xerox was a verb when I was growing up, right? You didn't make copies, you Xeroxed them and they're gone. Commodore Computers was the biggest computer company in the world in the 1980s. And no one remember. You remember, Mike? That's good. Most people don't. And so Enron, WorldCom, you just look at all these losers and you go, wow, I really wish I'd gotten out of those. Well, they got replaced by winners, and there are more winners than losers in the free market system. And so when you start picking and choosing, you take the chance you have a better chance of missing the winners than you do getting rid of the losers. And so I think that it's, for us, owning the entire market. And so then you have to say owning the market in what respect, right? And so how much do we put in international versus U.S. and all that, because there are home biases, right? And no one has a home bias more than the United States. We're very impressed with ourselves. But honestly, there's home bias everywhere. Indians like Indian stocks and Vietnamese like Vietnamese stocks. Everybody's got a home bias, but ours is, we're kind of the Texas of home bias. We think we're better than everybody else. So we tend to have more U.S. stocks. And so right now, the split in market cap is about 61% U.S., about 39% international. Well, that's big compared to where it's been. Forever it was 52% U.S. and 48% international in there. But as we've had this run up in the last 8 years or so, we've gotten to this 60-40 split. But if you look back at the last 10 years, U.S. equities have averaged about 11.5% over 10 years, and they average 10 over a long period of time. So how do you get from 11.5 to 10? You underperform a bit. International equities have averaged about 4.5%, and over a long period of time, they average 10. How do you get from 4.5 to 10? You outperform. And so when people say, well, no, the U.S. is where it's at. I mean, it's just, we got to be there. Well, you don't have to look back far. The first 10 years of the decade were called the decade of no return for U.S. stocks because they literally had no return. And 8 out of those 10 years, international stocks did significantly better. And so you just think, I want to be objective. I want to use my prefrontal cortex to make cognitive decisions and reasonable decisions on long-term goals with companies. And I want to be there when those things happen. When we revert to the mean, I want to be there for that. So really the thing that we try really hard to do is not let our emotions get in the way of the fact that we don't want to lean into certain things and lean out of certain things just because we have a gut feeling about it.
Thank you.
That was not a boring answer whatsoever.
I totally agree.
For some people, it might be.
So let me ask you our final question here. This is a question I always save for the end because I like this question the most. What's your view of the economic outlook? You know, we've had so much that's gone on in the last several years, the interest rates and the market.
Yeah, I know.
Yeah, talk to us about that.
So you're going to get another one of those answers.
Perfectly fine with that.
So every year I try to come up with, sometimes it's a year and a half, try to come up with a quote that represents things that have happened in our firm in the past that we've had challenges with or whatever. A few years ago, it was George Bernard Shaw said the biggest problem with communication is the illusion that it has occurred. Because everybody thought they were communicating with people and they weren't. And then one year it was nomenclature matters because in our business, people say, it's really interesting. If you're an advisor with an O, you don't take on discretion to have fiduciary liability. If you're an advisor with an E, you do. Problem with that is most people in our business don't really know that either, and so they misuse their own name and that kind of stuff. And so understanding the difference between a consultant and an advisor. A consultant doesn't take on fiduciary responsibility, an advisor does, unless you don't know that, you call yourself a consultant, and you do. And so nomenclature matters. And so this year, especially in a presidential year, which is kind of the worst in the cycle, is a presidential year. If you've got a second, I'll tell you why. But and so there's this commercial out right now for shingles that says shingles just doesn't care. And it would say, like, Ashley runs 4 miles a day and works out and eats right, and shingles just doesn't care. Mike plays with his family. He's a great community. He is involved in his community. Shingles just doesn't care. And so my tagline this year is the market just doesn't care. It doesn't care who the president is. We like to believe that's important. It doesn't care if our debt is higher than our GDP. If you look at the last 13 times that's happened across the world, 10 of those times the market went up. It doesn't care about interest. It just doesn't care about a lot of the stuff that is important. So is the national debt important? Absolutely. Should we do something about it? Absolutely. Is it going to affect the market? Yeah, probably not. And then in this year, especially because, and you can look this up, you don't have to take my word for it, but the FCC, it is the national broadcasting services in our country do not have to run ads for people that they know aren't telling the truth. If Hardy Reid ran an ad that said, we guarantee you 15% a year, they would go, yeah, we're not going to run that. We know that you can't do that. But they're required to run political ads, regardless of whether they're true or not. They're required by law to run them anyway. So the only people that get a free pass for lying are politicians, which doesn't make any sense at all. And so they really can say anything they want to. And so in a presidential year, you've just got this massive amount of untruths that are coming out and that you're having to deal with. And so somebody comes in and says, hey, inflation is the highest point it's ever been in history, and we've got to get out of the market. And you go, first of all, markets do better in inflationary environments. Second of all, it's not anywhere close to the highest inflation in history. You just have to unwind over and over again. You have to unwind things that clients hear this year. And so I go back to the shingles commercial. The market just doesn't care most of the time. It's up 70% of the time. It's down 30% of the time. It really doesn't matter who the president is. It doesn't matter really what the national debt is. It doesn't matter about a lot of that stuff. The free market system is a global, worldwide system, and it's going to keep chugging along if you just let it come to you.
Thank you.
Patience, always the key.
Yeah, I'm not particularly that patient a guy, but it seems like it works out that way.
Yeah, it's like what Warren Buffett said. He said the market rewards the patient by taking money from the impatient.
That's exactly right. It's a great quote.
Yeah,
I love that quote. Yeah,
love it. Well, Scott, it's been an absolute pleasure having you on the show today. That concludes another episode of the What Matters podcast. Thanks so much for sharing your insights and experiences with Mike, I, and our audience.
Well, it's been really nice to spend this time with y'all. I look forward to spending some more time with y'all somewhere down the road. Yeah.
Likewise. Thank you so much, Scott. And to our listeners, thank you for tuning in to another episode of the What Matters podcast. Remember, it's not just what you do, it's about why you do it. Until next time, take care and stay curious.